my mind. Looks like we're in the click, 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 just living the.
What is going on, you guys, and welcome back to another video. My name is Brandon. I'm joined today with my father, Marc. Hi, Dad.
Hey, Brandon.
What's going on?
Well, I'm just looking forward to a healthy debate, to chat with you today, because I know the topic of today's video is going to be speaking of some of the differences that I have as an investor and you have as an investor. And I'm kind of looking forward to having this discussion with you.
Yeah, you would call it a debate, call it a discussion. I want to get this off the bat. You know, no bad blood here, okay, Dad? I'm not here to try and hurt your feelings. I'm not going to take any offense to what you have to say. But that's exactly it. In this video, we're actually going to be going over a couple of differences in our perspective on a couple of our recent videos. And the cases that we are going to talk about today are the Ford versus Tesla debate, which was a video. If you haven't checked out, you can feel free to go search that up on the channel. Also, the second part of our video, we're going to be talking about the selection of Chinese stocks and our variance in opinion there. And I think, you know, one of the major objectives about bringing you on the channel was exactly for this, right? It's exactly to get these different angles and different viewpoints on a specific topic, because in the world of investing, that's really the name of the game. Anytime you buy, someone's selling, you're always going to hear two sides of the coin. And it's not to say that one is always right, one's always wrong. It's just two perspectives. And
absolutely.
I hope we're able to achieve that today.
Well, one of the things I remember most when you started working with me years ago now was that difference of opinion. And you came in with these fresh eyes and, at the time, no experience. You had invested, but you had no, actual managing portfolios experience. And, I had a more traditional bent on things, and I think we merged a lot of our thoughts. I actually vividly remember thinking, gee, I was maybe a little bit stuck in my ways, or, sort of in a groove, and you sort of jolted me a little bit with some of your ideas. And I know today we're going to, or, at least in your argument, you're going to talk about some of the ideas I had that you weren't in agreement with, and in some cases you were right, and in some cases I was, and it's like you say, if I want to sell a stock, I got to find someone who's willing to buy it, and vice versa, and so there's always differences of opinions, and I think today we're going to talk about exactly the intergenerational, what some of those key differences are, and they're pretty stark, I think.
Pretty stark. And I will just say as a quick disclaimer, guys, for the most part, 99% of the time, Dad, you and I, we align with what we think about. You were my mentor. You were everything. Everything that I know is kind of brought up through you. So in general, I'd say that we are very, very much in line and in tune with our beliefs in the market. But as you said, there are still these variants in perspectives. And I don't want to say we're playing devil's advocate here, like kind of picking sides, but it's just we're going to be essentially playing a bit of a debate. And
I'm guessing that from time to time over the years, Warren and Charlie have had disagreements as well, or had differences of opinions. We're certainly not on that scale. But no, that's what you say is true, and that's a healthy thing. I think two brains are better than one. Conceptually, on the objectives of investing, what it means, how to do it, we're really closely aligned. And even some, we talked about the Chinese stocks, and when you talk about buying Chinese stocks, you still talk about buying them with a long-term investment horizon, right? So, you're not trading, you're not in and out, you're not flipping, you're trying to buy great companies, and we'll get to this, but I think you've identified some awesome companies, which is not my issue at all. We align. It's just, we have these subtle differences.
Yeah. We'll call it subtle differences. But hey, why don't we dive on into things, guys? Let's get into it. If you guys enjoy this video, do not hesitate to leave a thumbs up and share your comments down below. We'd love to hear from you guys, what you think, whether you agree with either one of us. But let's start this video off with going over the Ford versus Tesla debate. And this is referencing, for those that didn't catch our previous video, Marc, you made a video basically comparing the two. And correct me if I'm wrong, but was the takeaway there that Ford is currently a more attractive buy than Tesla? Is Ford a better stock to own? Do you prefer Ford as a company over Tesla? Maybe clarify that a little bit before I kind of get into what I have to say.
Sure. The number one thing that I identified in that video right from the outset was, if you had asked a lot of investors, if you go back a year, which company has done better from a stock performance perspective, Ford or Tesla? I'm guessing 90% of the people would have said, well, Tesla, obviously. The day that I prepared that video, coincidentally, I pulled up a chart from that day, and Ford had in fact their 1 year number had outperformed Tesla during that time period. So that was kind of the point is, we get into our blinders, and if I like Ford and if you like Tesla, the tendency is to just focus on that one investment without looking at the other side of the coin. So that was sort of the main thing. The other main point of that was it's always, in my opinion, always comes back down to valuations. And a big chunk of that video was talking about, if you look at, I'll admit, traditional valuations, they're not even close, right? Tesla is trading at such high values that I'm saying you need to be aware of those and be prepared for what that means. If you're saying their PE earnings up at like 140, then you know what that means, right? You're paying $1 for 100. It's going to take you 140 years to get that dollar back if all else it goes equal, as opposed to let's say 12 or 14 for a more traditional automaker.
Yeah.
I wasn't, and to answer your question directly, was I saying that if I was buying today, I would pick Ford over Tesla? I very well might do that today. I think right now it's a bit of a toss-up, and of all the videos I've contributed since I joined your channel, Brandon, I mean, clearly this was the most divisive when it comes to comments.
As expected, of course that's going to be, but yeah,
as expected. And for those who are Tesla bulls, go for it. I mean, my goal wasn't to say Tesla sucks, and I did make one. I worded something wrong. I think I said somewhere in Tesla, with Tesla, I said their glory days are behind them, and I didn't mean to say that. What I meant to say was the honeymoon is over, if that makes sense. Tesla has been clearly the leader and the innovator, and they've had such a head start. My point is, the other automakers are all catching up on the technology perspective. I know even that comment will bring a lot of response, or even that, because so many people think that Tesla's so far ahead, and so be it. So I misspoke. The glory days of Tesla, they have a long runway ahead of them. It's just the easy work that they've done so far as market share, that part is behind them. So I don't know if that answers your question, Brandon, but
it did. It did. It clarified because it did clarify, I guess, your stance. And even in your little explanation there were a couple of things that just kind of got me like, oh, maybe I don't necessarily agree with that. And maybe I'll start with one thing here that you said right off the bat, because you talked about Tesla not following traditional metrics. How if you looked at, you said, what did you say there? You said that if you looked at something like traditional metrics, like a PE ratio, for example. Sure. One of the examples that comes to mind with me was a company like Amazon, which for decades going back, I think Amazon is one of those unique cases that did defy the traditional metrics. And if you did just base your research and your investment thesis off of, for example, the price to earnings multiple, and said, well, it's too high, I'm not going to invest in this. Well, to me, Amazon is a prime example of a stock that, again, it's not apples to apples. I know they reinvested a lot of their money, and they, basically chose not to take earnings for a long time. Sure. But that said, if you were to compare apples to apples in a sense, just because a stock has a high price to earnings multiple like Amazon or like Tesla, is it not possible to say that this company is unique in that sense and it doesn't play by the same rules that many other companies do?
I would say absolutely, but those are really diamonds in the rough. And Amazon, and one of, I look back over, you see a lot of videos of my biggest mistakes as an investor, and one of my biggest, I'll call it mistakes I ever made, I owned Amazon back in the day, made some money on it, and at the time that I sold out, I think the PE might have been up in the 400 range, somewhere at that lofty level. And as much as I felt and I wanted to continue to own this company, I just couldn't. I went back to my roots, if you will, of how to manage money. And I sold out. And, as we all know, for years, your point, Brandon, Amazon wasn't profitable. So when you look at the PE, you look at the price to earnings, and they artificially knocked their earnings down as all the money went back into the company. So their PE was artificially high. And certainly looking back, no question. I mean, I own Amazon again, but I wish I would have held it, from the early days, right?
Yeah.
Now, I don't see a parallel there with a Tesla, where Tesla is not putting all their money back in. I mean, they're struggling with revenues. They've
some
started
money,
to
yeah.
generate revenues now, but it's a different scenario, in my opinion. It's not really an apples to apples there. To your point, though, does a PE ratio, a high PE ratio, mean that the company cannot succeed? Absolutely not. It's just one of those starting points. Price to PE, price to earnings, price to book. There's lots of metrics that you would look at. So no, very valid point. So Amazon is the prime example, but you don't see a lot of those out there.
You don't. I do agree with you there. That's not the standard, and I think it'd be dangerous to think that is. But another thing on the topic of these traditional metrics, one of the things that I think potentially puts Tesla in that category of diamond in the rough, very, very unique and very, very one-off. Tesla to me is one of these only companies that I publicly know of, or that I know in the public market, that can quarter after quarter, year after year, miss their deadlines. They can have these huge, outrageous promises, and Elon Musk says, we're going to deliver X amount of cars here, we're going to do all this, and they come nowhere close to that. And it's almost like Tesla shareholders come to accept that. You've been following Tesla. I know you don't own Tesla, but you've been following it just out of interest for years now. And I remember having this discussion back when I was working for you, talking about their deliveries, missing them. And the shareholders, in a weird way, tend to not care. And how many companies can you say that about? How many companies can you say, oh, we missed our deliveries by 500,000 units, whatever it is, and the share price doesn't tank 30%? Practically none.
You see the reports, and you're expected to earn $1.10 per share.
Yeah.
And it comes in at $1.08, and the stock will drop 7% overnight, right? Just because of the small little misses like that. Very valid point. Now, I would add to this discussion, Brandon, the fact that the Tesla shareholders are, almost cultish in nature, and will stick through the company through thick or thin. To me, that's kind of irrelevant. They don't make the company. They don't sell more cars. They don't build better cars. They're investors. What's that?
In a question, I'd say, is it though, with the recent GameStop, for example? Let's look at the GameStop situation with the Reddit investors, the retail investors. To me, that was a very, very eye-opening situation where it's kind of coming to fruition. It's kind of proof that if you do have these cult-like followings, and if you are able to get these movements behind companies, they can have significant impacts in the performance of the company, right? Again, I'm taking a very counter argument here, and know my opinion on Tesla to begin with. But what I'm getting at is that, again, maybe this is just a young perspective, but and we've talked about this many times before, but with technology changing, with the new ways of getting information, with the cult-like followings that develop around these brands, and a Tesla is a prime case of it, is there a chance that these traditional metrics just don't apply? In my opinion, you see it in the case of missing their quarterly earnings and that not being the biggest deal. Very ambitious targets. Maybe people come to like that, and again, I do agree with you that valuation does matter at the end of the day, but it's just something that I think a younger person may ask or may consider that maybe an older person wouldn't.
No, probably true. And when I analyze a company, I mean, I look at those traditional metrics almost as a starting point. You do your fundamental, but that's something that sort of is ingrained in me to do that. Whereas, I'm not going to go on and look at a GameStop and say, because a Reddit stream has knocked the price up 1,000%, I'm looking at an investment, which to me, and for most of the people who certainly follow our channel and are interested in accumulating wealth for their retirement years or to buy a house down the road, you're not looking for something where you're in and out in 2 weeks. When we talk about, and I hope Tesla isn't like this, but when we talk about the GameStops of the world or the AMCs, most of the people, keep in mind, and I mean I don't have the stats or the evidence to bear this out, but it happens over and over. Most of the people who made the money on that are the early adopters. And they wrote it up. Every second comment you got on your YouTube stream was, buy this, buy that. And then if you look at the flows of when the trading that went into those companies, it was close to the peak, typically at the peak. And so most investors lost money.
because they.
Is there a parallel between the pump? I would almost call it a pump and dump, but pumping them up. I don't even see Tesla as that. I see Tesla as much more than a company like GameStop.
So I didn't mean to say that that was a parallel. I'm just saying that the fact that happened potentially may the influence that it has, is that not a variable to consider that that may set some company aside from a normal company, let's call it.
I suppose, and if it could allow, I guess to your point, it could allow a company, like, I remember looking back a number of years ago where Tesla was, debt deadlines. Going out and raising money has never been an issue. And a lot of that is because there's people willing to put money in, right? So to your point, Brandon, maybe the fact that they do have these loyal followers who are willing to, almost take a blind eye to what really makes a company run, because there's tremendous potential. Kudos, you're right. That could help them be sustainable for the longer term, whereas a company without that following would have run out of money a long time ago, and they would have gone to the market and would have been able to raise it. So they'd be, distant history at this point.
Agreed. Yeah,
I think that's a very good point.
And I'm just again, the viewers of the channel know my opinion on Tesla, and again, it very much aligns with yours. But these are some of the things I do consider for a counter argument, and with that, I'll actually transition to basically my second counter argument against this pick, and then maybe we can transition to the Chinese stocks, because I know this video is already going longer than it's already pretty long, but that's okay. One of the other things that I disliked about the video, or not disliked about it, but one of the things that just comes to mind is, like, to me, I look at a company like Ford, and it's just such an old traditional company, kind of a definitely at one point a superstar in their area and a big competitor in the automobile industry, no question. But one of the questions I have for you is, do you think that you are also being biased in a sense to these companies that you grew up with, and companies that have maybe passed their heyday, and like you said at the top of this video, they're making some great advancements in new technologies and EVs and whatnot, and hey, I don't want to discredit that, but wouldn't you rather be on the more or less forefront of change, kind of getting on the side of technology and advancement, than to latch onto an old company with that may be kind of on its way out and getting a last minute injection? And the reason I say that, Dad, is I'll give you a little anecdote with me. A few years back, maybe 3-4 years ago now, I bought into GE, a company that like at one point was a powerhouse. So I put up the share price of GE. This was even before my time, but any book I go back, any type of thing that I study and read back, like GE was GE. The model. Right? It was the model. And I also think to companies like IBM, which I know, again, before my time, but these companies were the poster boys and the superstars of the day. Yet I had a bad experience with GE. I ended up selling that investment for a loss. I tried to kind of take a value play. I went in. I took a bigger loss for me at the time. And it left a sour taste in my mouth to say, maybe I don't want to latch onto these old companies that are past their prime. Why not take the gamble or take the leap on a new company? What are your thoughts on that?
Well, and a couple of quick points on that. First of all, I did not own a Model T, so I'm older than you, but I'm not that old. Secondly, I just thought of this now. My very first car ever was a Ford Custom 500, a big green beast that I drove from Brandon, Manitoba, out to Vancouver when I moved out here in '81. So I do. Maybe there is subliminally to me some nostalgia. There very well could be. Maybe I'm one of the Ford cultists. I'm not sure.
Maybe.
Now, when I think back to when I evaluated today Ford versus Tesla, where we're at from the metrics, I don't believe that there was certainly no conscious awareness of that type of a thing. To your point, I know, I'm going to name a few older companies that I think will. I don't think it's an issue that I really need to be concerned about. But if we look at Ford, for example, Ford was founded in 1903. So it's old. IBM 1911 and GE 1878. So those are the three companies we just talked about. Now, by the same token, I'm going to name a few companies. JP Morgan Chase 1799. It's live and well today and growing. DuPont 1802. Colgate 1806. Procter & Gamble 1837. And right here in Canada, Fortis started in 1885, or his predecessor. Those are some companies that I know you own some shares of some of those companies today, and the fact that it's a dinosaur, I don't think means that it can't do well. Not at all. Does it mean it will do well? Absolutely not. And I know when during the recent Berkshire Hathaway AGM, they looked back at the behemoths of the day, and I think it was 30 years later they looked forward, and most of them don't exist in the same form, or they're certainly not leaders in their field. So yeah, I don't think so, Brandon. I don't think that would influence me, but maybe beneath the surface somewhere there is a piece of that. But I don't think it should be a factor. You want history, but you want 10 or 20 years of history. You don't need 100 or more years to prove a company's going to do well. But good question.
I'm just looking at these stocks that you named there in this list, dating back. This is my first time looking at them. And, one thing pops to mind right away. I look at, for example, a JP Morgan or a Colgate or a Procter & Gamble or even a Fortis. Tremendous track records, tremendous histories of being in operation. But to me, what jumps out to me about those names is that they're in much more sustainable industries to succeed long term. And what I mean by that is if we were to look at a company like Ford in a very competitive, very cyclical, constant need for adaptations and constant need for new models and very, very costly
R&D is enormous.
Machinery. It's a very tough industry to be in. Even at IBM, which in technology, you got to be constantly evolving. You got to be constantly changing and adapting to the consumer's needs. I don't think it's fair to compare those to a company like Colgate or a company like Procter & Gamble, which are consumer staples, which pretty much year-round people are going to be needing their stuff. It's a little more, I would say it's easier for a company like Colgate or Procter & Gamble or Fortis to sustain success 100+ years down the road.
Because of the industry they're in.
Because of the industry they're in. And again, I don't think we need to get too deep into that, but that is one thing that pops to my mind just with those names. But it's a very fair point that you make. I really agree.
Well, and that what this discussion reminds me of is as part of the Ford Tesla illustration, if you will, I used an example of the evolution of Microsoft, and I remember vividly when Microsoft was being counted out. Now, you can't compare Microsoft, a tech company, with Ford, an auto company, but the feeling was much the same. You're old now, you're not keeping up, we're going in a new direction, it's all digital, and Microsoft was able to make that transition. They were late out of the gate, but they made it, and now as one of the most valuable companies in the world again. And I mean, who knows what the future will bring with a company like Ford or a Toyota or a GM or whichever automobile manufacturer you want to look at. But I've lived through that scenario where the old guys are being counted out, and then they down for the count for 8, and they got back up and knocked the opponent out. So we'll see where that plays out. Only time will tell. But I think
that may be your experience talking there, and if you've seen it before, again, that's something that's a perspective that I can't bring to the table, right?
Well,
but that's
very good point. And as I was thinking about this video today, I do have obviously a lot more like firsthand experience. You've read the books, you've done the studies, I've lived through it, and that doesn't mean that. Well, certainly I don't know it all. And that could be a trap, but there's what's the famous saying? If you don't know history, you're bound to repeat it, or something along those lines, right? And you do learn from the past, and sometimes maybe we're slow to adapt, and I guess as an older investor, if I have to err on the side of two things, I got to err on the side of blowing up because I don't want to acknowledge the fact, and the old saying, this time is different. In fact, there's a couple of snapshots or headlines I'll put up here, or ask you to put up, but just this time is different. This type is different is like for the most dangerous words in investing, right? And again, having lived through that personally, most this discussion is much like we saw back in the tech industry, the tech crash back in 2000, 2001. Where the old metrics didn't matter anymore. Well, they did at the end, and it didn't mean that every company. I think of Cisco back in the day. I think maybe even the largest company in the world dropped, I believe, 80% in value through that crash. Now they're still around today. They survived. Most didn't. Right. So so good discussion. The experience is good in one hand, but it may hold you back from. And we've talked about Charlie and Warren, and for years they didn't invest in the tech sector because they didn't understand it, right? That cost them a lot of money, or they left a lot of money on the table. And I know Charlie now is an advocate of the Chinese stocks, I guess is what we're going to be talking about next. But their traditional ways held them back a long time, but then they've been evolving and adapting. So maybe you'll teach me a few tricks here too.
Well, that's fair. No, that's let's move on to talks about Chinese picks. But I just want to say first of all, I really, really respect your opinion on all of that. Again, you already know that I do. If I had to pick a side, I do align with you there, and I don't own Tesla. I guess more or less, if I had a takeaway, it's not that I think Tesla is going to continue to do so much better from this point on, because these multiples are just already so high. It's already one of the largest companies in the world, and they have to kind of fill those shoes. But I guess my argument would be more or less that Ford is not a company for me.
Totally understandable. And it's like going to a buffet, right? And you can pick different types of meat.
Spring rolls, exactly.
Yeah, we're at a buffet, and I'm going with the old traditional roast beef and Yorkshire pudding and mashed potatoes. So good.
Yeah. Nice. Well, let's move on to the Tencent Alibaba pick, and you kind of preface that with Charlie Munger being a shareholder in Alibaba, and from what we know, he's also down on his position, as well as myself. I own both Tencent and Alibaba, and I know those are stocks that I guess more or less wouldn't be. Would you say they're not suitable for you? Would you say they're not stocks that you would feel comfortable owning for yourself as an investor? What's your gig with the Chinese stocks?
Two parts to it. Number one, those companies that you just mentioned and that you own, and as a matter of fact, as part of our portfolio challenge experience, we own them in the growth portfolio. I know we own Tencent for sure. We own Baba
and
as
Baba,
well, right?
and Baba now, yeah.
So if I looked at them as a company, and if their headquarters were New York or Atlanta or Boston, I would say, gee, we really need to have a piece of this action because they are phenomenal. Right? What they're doing, the direction they're going, absolutely. From an actual company perspective, I'm all in. Where you and I differ is the risk that's associated with that. And again, maybe going back to me being stuck in ways, but literally as a young advisor, so I would say probably in the mid to late 90s, I remember being in a meeting with a portfolio manager who ran one of Canada's mutual funds back in the day. And the question that came up is, in your portfolio, you don't have any Chinese stocks in there or any Asian exposure. And the simple, blunt answer was, no offense to these companies, but the answer was, well, yeah, because my job is to analyze companies and make decisions based on that information, and you can't trust a thing you read from the reports or what you hear. And his comment back in the day was, until that's fixed, where we can look at an annual report, look at the the footnotes and trust them. It's one thing if you're taking your own money and doing that, but in this case, he was a fund manager, a portfolio manager for one of Canada's largest global mutual funds. Well, he was now responsible for other people's money. So he didn't feel that he could take that risk, essentially. And I'm in that exact same camp. Simple line, if I look at those companies with the risks that are inherent, and I know we're going to talk about a couple of examples today of what those risks really are, I'm going to take that 2% of my portfolio or 5% of my portfolio or whatever I would have in a position like that. I'm going to look for something.
Just cross it off it's off limits.
I'm not going to look at it. And do you miss some opportunities because of that? Absolutely. But there are some, there's always great opportunities out there. And I would rather look at something else. I've had this rule since I was young, since I started investing, that if you, when I buy a company today, I look 10 years out and say, quite simply, will this company be around in 10 years? Forget what it's done up or down, but will it be there in 10 years? And I can't imagine a company that I would own that the answer to that would be, I don't know. I mean, like a Coca-Cola. I own Coca-Cola. I predict they will be there 10 years from today. A company like Tencent, may they be there? Sure, but there's a real risk that you won't be able to invest in it. And when that, because of the Chinese laws, and if that happens, they're not going to say, by the way, in June of 2022, we're going to remove that from the stock exchange. It's going to happen overnight. There's all kinds of buzz about it, so you can anticipate. And the fact that there is that buzz, that gives me red flags. And even with my own money, I'd rather look somewhere else.
Sorry, go on.
Yeah,
I
I'm saying you're a younger investor,
something.
so I'm curious as to your take on the risk element of it.
Right. Well, before I go into that, I'll happily share my opinion on that. But one thing that I just want to touch on, when you said, for example, that fund manager in the 1990s not wanting the Chinese exposure, question for you, fast forward 30 years later to today.
Yeah.
If that fund manager was still here, still doing his thing, maybe he is or he or she.
Yeah.
Do you think they have Chinese exposure now? Because 30 years from when you talked about that,
Yeah.
I think and I touched on it on my video too. I said it's very fair that looking back a couple decades, when you look at the financial reports, when you look at the accounting, there has been improvements. I think in a major way that people tend to overlook.
Okay.
But like a 30-year time period, I think is quite a long time to still be in that frame of mind.
And,
Yeah.
And it's maybe splitting hairs, but I think we're looking at probably a 25-ish year time period.
Yeah.
Sure. 20, 25, 30. I know.
I was rounding up to make
rounding
the
it
point.
up. Yeah.
Okay, I got it.
No, just to be accurate there. But my answer to that is probably not with this person. And if he had those true beliefs, you never know. He might have just been saying that to make a point.
No,
if he had
yeah.
those true convictions, I don't see that enough would have changed recently, and especially now we're hearing all kinds of like say chatter.
Threat, yeah.
And so
it's still apparent, is what you're saying.
Yeah, well, to me, the risk is very apparent. Yeah.
And I do agree with that, and I do totally acknowledge that. To kind of move on to where my thoughts on the risk play, it's not to downplay those. It's not to ignore those, because you're right. I think things have gotten significantly better, but there still absolutely is that risk. That is a legitimate concern and a legitimate factor that you have to consider when you're looking at that market. My thoughts are that with these two companies in particular, they are so large and they're so multinational, as I've touched on. I don't want to repeat myself, but they're so truly involved in the global system that it'd be a different story if we looked at a very, very small Chinese company, right? Part of the market that maybe is a little less certain. But these companies like an Alibaba, for example, are so developed and so multinational that yes, the threats are still there, but to me, is it possible? Yes, these types of things can happen, and that's I think if with every investment you have to basically play the odds and say, well, is there an odds of this happening, or the odds of making a good return? And you got to weigh that out. And I think for me as a younger investor, I'm willing to acknowledge those odds that there is a chance that these companies do get delisted. There's a chance that these companies, you're not able to invest in them here from the North American markets. You can always go buy them on the Hong Kong exchange. But because these companies are so multinational and so large in their scale, in their scope, I question whether they would be not subject to that, because they would, but it kind of it gets me thinking a little bit that I tend to believe that that's not going to happen. That's my side of the bet.
Maybe I'm just being too conservative, and
but maybe you're not. Maybe in the sense I'm being too risky in many regards, because it's funny. Like as I was saying that, I was thinking back to our first part of this video. We're talking about these big behemoth companies like the GEs, the IBMs, and companies can't be too big to fail, right? Some do. These big companies do fall. So especially with a government like China, I do agree that there anything can happen. But as I touched on in that last video, by trying to understand their motives, I don't believe that's what they're after, and that's just a personal opinion there.
This takes me back to I guess probably around 1996-ish or so. And we were at the Abbotsford Air Show in Abbotsford, BC. And you and I were there, and the show was over, and you were quite impressed. You were one-ish at the time, and when we were walking back to the car, I was holding your hand, and all of a sudden you just bolted out of my hand into, you saw something that attracted your attention, and you evaluated the risk of running into traffic quite differently than I did, right? Now, mind you, the consequences then would have been much worse than if you lose your position in Tencent, right? But that's an extreme example of how absolutely, I think what you're talking about is our assessment of the risk is quite different, and so we will make a decision based on that. Now, I will take a moment to say, if you have 2% of your portfolio in a company like Tencent, and overnight it disappears, most investors will survive that. Okay, there are a lot of investors who have a very, very concentrated portfolios because they're in love with the company, and
some are all
that's where the danger really comes in. Now, I believe that for most part of an investor's lifespan, every position in the portfolio should be meaningful, and it should be there for a reason that's well thought out. I don't think it's just be like, I heard something, so let me put it in. I'm not a gambler. So, if I was going to take 2 or 3%, I would put into something that I feel comfortable with. Would it be catastrophic if you lost that position? Of course not. But you also got to make sure it's not indicative of, well, I've got Tencent, I've got Baba, I've got X, Y, and Z. So now all of a sudden you look and you've got 15 or 20% of your portfolio in that VIE structure, for example, which I hope we can talk about for a little bit. And then now the risk profile is higher than I certainly would be comfortable with. So
Absolutely.
If your investment policy statement says, yes, I'm willing to put X into risky stocks, understanding that I could lose that money, then hey, I would pick a company that has the potential, like a Tencent for sure.
Yeah, I think that's we can talk about the VIE structure in a moment, but when you mentioned their gambling, it got me thinking. I know you don't gamble. I know you're not much of a gambler. In fact, I don't think you really gamble at all.
At all.
But and that may be the difference between you and I. Sure. If I'm at the blackjack table and if I get dealt an 11 off the bat and the dealer draws a 6. Some people would just say, hey, hit me. I'll just play that out. The odds are in your favor in a hand like that. Yeah. But you always have the option to double down. And I think when the opportunity's there, if your situation calls for it, and I know you've mentioned that, maybe for me this is more suitable, but if your situation calls for it, I think that this, being a younger investor, being someone that, like you said, is not going to get crippled by this, I'm not in retirement or anything. It's opportunities like that you can strike on and take the chance on, factoring in the risk, factoring in the fact that you're putting more risk on the table, but that's how you can strive for more growth, and that's the way I really approach it. But yeah, maybe we'll touch Maybe we'll touch briefly on. You mentioned the VIE structure. What are a couple of the main things that just say for you this is off bounds, like off limits?
Well, just for those who may not know, VIE is a variable interest entity. And when you own a company like, I'll just use Tencent as an example. Like when I buy a company, you always look at the structure of security. So if you buy a bond from the company, for example, and the company goes bankrupt, you have claim to the assets ahead of a common shareholder. If you buy preferred shares, there's a structure, a ladder, if you will, and the common shareholder is right down at the bottom, right? Mm-hmm. And there's more protection ahead of that. But you do have a claim to the company. The way that a VIE structure works is there's a company set up, an entity set up, typically in the Cayman Islands, and you don't actually own any part of the company. This is a Chinese company, and it is illegal in China to have foreigners own your company. So as a way to get around those rules, they set up a shell. Yeah, it is a shell company. So, and what that shell company owns is contracts with the parent company, essentially, that says if you put your money here, you can exchange it for value in the company. But at the end of the day, if something happens with that company, you don't have anything. This structure is, in the eyes of the Chinese, illegal. So if you go back to them after the fact that you've lost your money on Tencent and said, I want my money because I have this contract, they'll say, well, the contract's illegal. You can't enforce that. And I have a couple of examples, and a lot of people probably don't know this, but I made a couple of notes here. I'm old enough to remember back when the Enron scandal occurred back in 2001, and this was all part of the tech crash. And basically they had misled, they had wrong accounting information that led their revenues to look so high, their profits to look so high, and people were pouring money into Enron. When the scandal broke and was discovered, they blew up, and there were some of their top guys who ended up getting jail time because of it. And my point on this is that the VIE rules were restructured following that, so they were essentially a precursor to the VIE, and this is right here in North America. So even in the U.S., the rules were restructured to fix this problem up. Now, if we take that and go to China, a couple of examples that come to my mind. 2011. So a lot of people, everybody knows who Alibaba is, and a lot of people know Alipay, and Alipay was originally part of Alibaba. And back in the day, Yahoo, the company, the North American company, owned 43% of Alibaba, and a big chunk of that value was Alipay. Well, overnight, you probably know this, Brandon, but I think a lot of people don't. Overnight, Alipay was just stripped out of Alibaba. So the government said, you can't have Alipay in Alibaba for whatever reasons that they decided. I think it was related to just control over the money, the flow of cash. They didn't want foreigners having access to that. And they said, as of tomorrow, this Alipay is no longer part. So Yahoo, at that point, lost a big chunk of their investment because the value of Alibaba was just overnight stripped out. And they were essentially helpless. There's nothing they could do. They couldn't go back. So I guess the point there, now they did, through litigation, they recovered some of the money through other means, but nothing near what the actual value of their investment was. So that strikes me as being dangerous. Now, another example, just a classic example. In 1995, there was a lady, I think the richest woman in the world, or in China for sure, Nina Wang, and she invested through her charitable foundation $11 million in the Mingsheng Bank. And as the years went by, and this was in a VIE structure, and in fact, the deal was structured to get around the rules that the Chinese government had in place. Her stake grew to $815 million, so a tremendous investment. Again, overnight, or when she went to, she died, I think it might have been her estate, went to say, we're going to, we want our money. And the government said, you can't have it because this is in an illegal structure. It went to court. And recently, the Chinese Supreme Court, I believe it was in 2013, the ruling that the Chinese Supreme Court ruled that those shares were invalid and that investment was lost. Again, there was subsequent litigation. I'm not sure exactly how that came to play, but this is the things that can happen in that VIE structure. There's just no security, not much to go back on. Another very, very quick example is recently, the Ant Group was scheduled to go for an IPO earlier this year, and about 2 days before, that was canceled. And that was, if I'm not mistaken, what I've learned, that was because Jack Ma, who was involved with the Alipay Alibaba scandal almost back in the day, said some negative things, and overnight, boom, the whole IPO was canceled. So this is the power that the Chinese government has. The North American governments have a lot of power, for against monopolies and what have you, but nothing to the extent that we're seeing here. Again, I'm just going back to I have a choice. I'm going to pick something where it can't just disappear overnight. So
that's
your thoughts on that, Brad?
No, you can't argue with that. And when you invest in China, you kind of hit the nail on the head there. It's basically like they have full say on what happens. And I guess your perspective is that you don't want to put your money somewhere where the government can come in and just overnight say something. I respect that. And again, I tried to kind of say this at the top of this video, or at the top of this section, but my opinion on that is that let's try to understand what the CPP or what China government
CCP
what their CPP. I've been seeing so many CCP
You're thinking
videos.
of retirement already.
Oh, geez, this stock's gonna get me there. But basically, the government. My thing is, let's try to understand what their motives are. You're absolutely correct that at any point they can just put the hammer down and just say, hey, this cannot be this way. This cannot be this way. That is
Right.
how that government works. And for many people, there's too much risk to say,
Sure.
like, even bother. But from my opinion, it's, well, hey, let's try to understand what they're trying to put in place. Let's try to understand why these regulations are coming in. And from my perspective, as I touched on in my last video, I actually believe that they are actually trying to kind of even the run. They're trying to make it a more even playing field for the long term. They're not trying to screw these companies over. If Jack Ma's going to come out here and start, disrespecting them, they just want companies to play within the rules, I guess you could say. And that's my take on it, more or less. But I do agree with you. If that's outside of the realm of, if that's just, it's just too much of a risk to take for many people, I do agree that I can't argue with that, right?
It's interesting because I know you played a lot of basketball in through your high school years, and the odd game you fouled out, and in your opinion, you were playing within the rules, but the referees screwed up, right? And so, I always said to you guys when you were little, if you're, the referees have the power; they can kick you out of the game if they want, even if you do nothing wrong. And so, I absolutely understand, and I'm not saying that the government is trying to crush these companies. Clearly, they're not. I agree that in many of these instances, they are doing. I agree with you totally. They're doing what's best for
They're doing what's best for the
viability. Right?
of the people, right?
Like we see here with the anti-competitive rules and laws, etc. So we're on the same page there.
They're just
for sure.
they're a little more savage. They're a little more cutthroat. I shouldn't say a little more. They're a lot more cutthroat. And I think if a company's off bounds, if a company's offside, they're going to pay the price. But
Yeah, and really, what this whole discussion comes back to is risk, and what am I willing to accept as an investor, and what are you willing to accept? I think that's really what it comes down to. Some good points, and I hope people who are watching can say, maybe I've learned some things here that I need to consider. And at the end of the day, I mean, there's people who buy penny stocks every day, right? And there's a tremendous amount of risk, but they still do it. Right. So we're not saying that you can't, or shouldn't even invest in some of these companies. I'm not saying that. But yeah, bottom line, just understand what you're buying and make that decision like everything else, and put your money in, put your money where your mouth is, and let it rip.
close your eyes and pray to the gods.
Exactly. See which way the wind's blowing. Yeah.
But
and
no,
we say that
that's-
somewhat jokingly, I assume.
Yes,
Yeah,
but
yeah.
no,
Good.
that was a really good way to kind of summarize things, Dad, because that is the point of this video, was to show two different perspectives, and we touched on it at the top that in any investment there's going to be two different opinions. There will be multiple opinions, and you as the investor need to formulate yours, right? You need to decide, well, hey, let's assess my own situation. Let's assess my time horizon. How much money I have. Am I in a position to take on more risk? Am I in a position to take on no risk? A certain stock may be very suitable for one person, but completely unsuitable for another. And as part of being a DIY investor, if you're watching this channel, you're managing your own money, the onus is on you to decide where that it is. You don't have an advisor working for you. You don't have a professional working for you. It's you that has to make that decision of where you fall on that spectrum. So I think we did a good job today of basically achieving the two different, basically displaying the two different opinions. And yeah, as we've touched on multiple times throughout the video, Dad, we do still agree on 99% of things.
Yeah.
And there's just these odd cases where the differences do come. And I think it's, as you said, it's healthy, it's normal, it's two brains are better than one. That's just the way it is.
One of the disadvantages I think a DIY investor has is that you typically don't have anybody to bounce these ideas off, and you may take in some information in one ear and then go like, okay, how am I going to act on that over here? And that is a distinctive disadvantage. So having at least two people to bounce it off of, or a community that you can do that, is very, very helpful. And even when I was working as an advisor, the advisors were constantly chattering with each other about what's your thoughts on this, or what's your take on that, and you share that information. And so this is good, healthy stuff. In our portfolios, we have the two separate portfolios that we're managing in our. It's not really a challenge, but it's building the portfolio, and we have the growth, and we have the balance. And I think we're going. Well, we've seen recently over time, in a very condensed period, a few months, of the differences between being more aggressive in one and being more conservative in the other.
Already,
and there's times where we already see that. And if you haven't, if you the viewers, if you haven't seen that that video. I think or that series. We probably have 5 or 6 videos out now, starting back earlier this year. And our goal in that is to show over time how the markets and the economy at different time periods will affect a more aggressive versus a more conservative portfolio. So, like I say, we're living through that right now, and when the glory days come back for those companies, we're going to see a pop there on that side of it. So
good. True. Yeah.
Well, I'm so glad that we do see eye to eye on most things, and clearly we wouldn't be doing this together if we didn't. And you learn so much when you're working with me, and but you're taking your spin on it. It's kind of like the core and then explore, right? So you're
right. And that's that's how every investor should be, right? You should never follow somebody's advice to the T, every single thing. Like, if you guys are learning from us as our subscriber base, take in as much information as you can, absorb as much of our philosophies and beliefs, and then tailor it to yourself. I think that's how every investor, every person is different. Every investor's their own investor. So you have to find a strategy that works personally for you. And I think
objectives are different, timeframes are different, all those core things that when you're managing money, what's the end use of that money will always factor in.
Right.
Good.
Yeah, and this video, I'm looking at our time frame here.
It's long.
Yeah.
It's
I
long.
had to charge my battery, if you didn't notice that. Halfway
I saw you leave the screen
halfway
there
through your spiel, yeah. But it was about to die. But no, it's I think we can wrap it up there, because
let's wrap it up, yeah.
If you guys have stuck through this entire video, you are a real one, and I want to say thank you. I'm impressed. We're impressed. That does mean a lot to us, that you care for our opinion and that you can take the time out of your day to watch what we have to say. If you guys enjoyed this video and liked to hear the difference in opinions, please do give us a big thumbs up. And as I said, let us know down below what you think. Do you agree with one of us more than the other? Do you agree with both of us? What is it? Do you disagree with what we have to say? All of that can be left down in the comment section below. You mentioned there a really great point, Dad. When it comes to DIY investing, just having that community to bounce ideas back off of, and just to be surrounded with others is so critical and so crucial. And hopefully we're doing that here for free for you guys to be able to, in the comment section, absorb on the channel. That's really what we're doing here for Canadians. But we also have it a step further. If you do want to check out our Investing Academy, we got a monthly membership group, lower ticket. We have a training program if you want to basically learn everything and go kind of gung-ho on learning everything. You have both those options, but you can learn all about that by clicking the first link down below. I think with that, we can wrap it up and enjoy the rest of our Sunday.
This could set a record for our longest joint video, maybe our longest video period, but
ever.
But it's been awesome.
It could be.
I'd like to do this type of thing more often.
Time flies.
Actually.
Time flies when I'm chatting with you.
Yeah, for sure. Okay. Well, let's wrap it up, Brandon.
All right. Well, thank you guys all for tuning in. More videos coming soon. Hope everyone's enjoying their summer. Dad, great to see you.
Nice to see you, Brad. Yeah.
Yeah, I'll see you soon. Hopefully in person sometime this month.
Sounds great. Okay,
awesome.
Thanks, Brandon. Thanks everybody.
Thanks for watching. See you guys in the next video.